Chapter 12, Standard Costs and Operating Performance Measures. This lecture extends our study of management control by explaining how standard costs are used by managers to control costs. And it demonstrates how to compute direct materials, direct labor, and variable overhead variances. And we're also going to define some non-financial performance measures that are frequently used by companies. A standard benchmark or norm for measuring performance is a standard or a benchmark. So in managerial accounting, there are two types of standards that are commonly used by manufacturing, service, food, and not-for-profit organizations. Quality standards specify how much of an input should be used to make a product or provide a service. For example, auto service centers like Firestone and Sears set labor time standards for completion of work tasks. Fast food outlets such as McDonald's have exacting standards for the quantity of meat going into a sandwich. Price standards specify how much should be paid for each unit of the input. For example, hospitals have standard costs for food, laundry, and other items. Home construction companies have standard labor costs that they apply to subcontractors such as farmers, framers, roofers, and electricians. Manufacturing companies often have highly developed standard costing systems that establish quantity and price standards for each separate product's material, labor, and overhead inputs. These standards are listed on a standard cost card. Management by exception is a system of management in which standards are set for various operating activities with actual results compared to these standards. Any deviations that are deemed significant are brought to the attention of management as exceptions. So here we're going to talk about management by the exception principle to quantity and price standards with an emphasis on manufacturing applications. The variance analysis cycle is a continuous process used to identify and solve problems. The cycle begins with the preparation of standard cost performance reports in the accounting department. These reports highlight variances that are differences between actual results and what should have occurred according to standards. The variances raise questions such as, why did this variance occur? Why is this variance larger than it was last period? The significant variances are investigated to discover their root causes. Corrective actions are taken, and the next period's operations are carried out and the process is repeated. Setting price and quantity standards requires the combined expertise of everyone who has responsibility for purchasing and using inputs. In a manufacturing setting, this might include accountants, engineers, purchasing managers, production supervisors, line managers, and production workers. Standards should be designed to encourage efficient future operations, not just a repetition of past inefficient operations. Standards tend to fall into one of two categories. Ideal standards can only be attained under the best of circumstances. They allow for no work interruptions and they require employees to work at 100% peak efficiency all of the time. Practical standards are tight but attainable. They allow for normal machine downtime and employee rest periods and can be attained through reasonable, highly efficient efforts of the average worker. Practical standards can also be used for forecasting cash flows and in planning inventory. So let's look at learning objective number 1. Explain how direct materials standards and direct labor standards are set. The standard price per unit for direct materials should reflect the final delivered cost of the materials, net of any discounts taken. The standard quantity per unit for direct materials should reflect the amount of material required for each unit of finished product, as well as an allowance for unavoidable waste, spoilage, and other normal inefficiencies. A bill of materials is a list that shows the quantity of each type of material in a unit of finished product. Six Sigma advocates argue that waste and spoilage should not be tolerated. If allowances for waste and spoilage are built into the standard quantity, the level of those allowances should be reduced over time. The standard rate per hour for direct labor includes not only wages earned but also fringe benefits and other labor costs. Many companies prepare a single rate for all employees within a department that reflects the mix of wage rates earned. The standard hours per unit reflects the labor hours required to complete one unit of product. Standards can be determined by using available references that estimate the time needed to perform a given task or by relying on time and motion studies. The price standard for variable manufacturing overhead comes from the variable portion of the predetermined overhead rate. The quantity standard for variable manufacturing overhead is expressed in either direct labor hours or machine hours, depending on which is used as the allocation base in the predetermined overhead rate. The standard cost card is a detailed listing of the standard amounts of direct materials, direct labor, and variable overhead inputs that should go into a unit of product, multiplied by the standard price or rate that has been set for each unit. Price and quantity standards are determined separately for two reasons. Different managers are usually responsible for buying and for using inputs. For example, the purchasing manager is responsible for raw material purchase prices, and the production manager is responsible for the quantity of raw material used. The buying and using activities occur at different points in time. So, for example, raw material purchases may be held in inventory for a period of time before being used in production. Differences between standard prices and actual prices and standard quantities and actual quantities are called variances. The act of computing and interpreting variances is called variance analysis. Price and quantity variances can be computed for all three variable cost elements: direct materials, direct labor, and variable manufacturing overhead, even though the variances have different names as shown. Although price and quantity variances are known by different names, they are computed exactly the same way as shown here for direct materials, direct labor, and variable manufacturing overhead. The actual quantity represents the amount of direct materials, direct labor, and variable manufacturing overhead actually used. The standard quantity represents the standard quantity allowed for the actual output of the period. The actual price represents the actual amount paid for the input used. The standard price represents the amount that should have been paid for the input used. In equation form, price and quantity variances are calculated as shown here. Transposed the earlier calculations to the row-by-row format provides a better visual image effect. In this format, all calculations are done systematically using column-by-column change when moving down the rows. Variances calculated can be observed easily. The trick of this approach is to ensure that the dollar-related figures are always on the far right, whereas quantity-related figures are on the far left. So on the first row, it starts with the actual quantity and actual price per unit, giving rise to the actual spending. So in this system, we move one figure at a time from the right. Therefore, on the second row, we change the actual price to standard price. Then the calculation is based on actual quantity times standard price. The comparison between the first row and the second row therefore give rise to the price variance because only the two rows are comparing the price difference based on actual and standard on the actual quantity purchased. The row below is always the reference. Therefore, if one row is greater than row 2, and if this is an expense, then the spending is more than the reference. Hence, the variance is an unfavorable one. Move on to the third row. We move the next variable from the right. In this case, it hits the final line, which is typically the flexible budget. Therefore, the third row is based on the standard quantity allowed for the actual output times standard price per unit. That means it is based on actual output times standard quantity for the actual production times standard price per unit. Learning objective number 2, let's compute the direct materials price and quantity variances and explain their significance. Here's an example that will give us an opportunity to compute material price and quantity variances. Using the row-by-row format, we can basically pick all the figures from the questions to fill the blanks and to calculate the variances. A Q equals 210 units. A P we do not need to know because AQ times AP equals $1,029. That's given. SP, the selling price, is $5 per unit. A output is 2,000. Standard quantity for production is 0.1 kilograms per unit. Therefore, SQ equals 2,000 times 0.1 equals standard quantity of raw material allowed for the actual output. Put all of them together into the model, we can get the variances automatically. Note that the total flexible variance is the summation of all variances, price and quantity, but is also the difference between the actual spending and the flexible budget. First row minus third row equals 1,029 minus 1,000 equals $29 unfavorable. The materials price variance, defined as the difference between what is paid for a quantity of materials and what should have been paid according to the standard, is $21 favorable. The price variance is labeled favorable because the actual price was less than the standard price by 10 cents per kilogram. The materials quantity variance, defined as the difference between the quantity of materials used in production and the quantity that should have been used according to the standard, is $50 unfavorable. The quantity variance is labeled unfavorable because the quantity actual exceeds the standard quantity allowed by 10 kilograms. The actual price of $4.90 per kilogram is computed by dividing the actual cost of the material by the actual number of kilograms produced. The standard quantity of 200 kilograms is computed by multiplying the standard quantity per parka times the number of parkas made. The equations that we have been using thus far can be factored as shown and used to compute price and quantity variances. Most companies compute the materials price variance when materials are purchased. They calculate the materials quantity variance after materials are used in production. The materials price variance is computed using the entire amount of material purchased during the period. The materials quantity variance is computed using only the portion of materials that was used in production during the period. The purchasing manager and production manager are usually held responsible for the materials price variance and materials quantity variance respectively. The standard price is used to compute the quantity variance so that the production manager is not held responsible for the performance of the purchasing manager. The materials variance is not always entirely controllable by one person or department. For example, the production manager may schedule production in such a way that it requires express delivery of raw materials, resulting in an unfavorable materials price variance. The purchasing manager may purchase lower quality raw materials, resulting in an unfavorable materials quantity variance for the production manager. In this example, the company produces a zippy. The direct material standard calls for 1.5 pounds per zippy at $4 per pound. Last week, Hansen purchased and used 1,700 pounds of material to produce 1,000 zippies. The 1,700 pounds of material cost a total of $6,630. Now we will see several questions based on the information on this screen. You may wish to take some notes as we try to answer the questions. To perform the variance calculations, plug the relevant figures from the question will provide the needed information. So here you go. AQ equals 1,700 pounds. Actual spending on the materials is $6,630. SP selling price is $4 per pound. A output is 1,000 zippies. Standard quantity for production is 1.5 pounds per zippy. SQ equals 1,000 times 1.5. So in this situation, actual spending of $6,630 is less than the second row. AQ times SP equals 6,800 by $170. The scenario indicates that the actual spending is less than the expected spending, the reference of a second row. Therefore, the price variance is $170. Comparing the second row with the flexible budget on the third row with the reverse scenario, the quantity variance, therefore, is $800 unfavorable. So, what is Hansen's material price variance for the week? We find the material price variance by multiplying the actual quantity of material purchased times the difference between the actual price per pound and the standard price per pound. We find the actual price per pound by dividing the $6,630 total actual price paid for the material by the 1,700 pounds purchased. The $170 favorable material price variance results because Hansen paid 10 cents per pound less than standard for 1,700 pounds of material. And what is Hansen's material quantity variance for the week? The standard quantity is the amount of material that Hansen should have used to make 1,000 zippies. We find the standard quantity by multiplying the 1.5 pounds per unit standard for 1 zippy times the 1,000 zippies. Now that we know the standard quantity, let's calculate the material quantity variance. We find the material quantity variance by multiplying the standard price for 1 pound of material times the difference between the actual quantity of material and the standard quantity of material. The $800 unfavorable material quantity variance results because Hansen used 200 pounds more than standard to make the 1,000 zippies, and each pound of material has a standard price of $4. Here we see a summary of the material price and quantity variance computations in a convenient 3-column format. You may find this 3-column format more helpful than the equations we used in the previous 2 questions. Let's extend the Hansen example by increasing the quantity of material purchased to 2,800 pounds at a total cost of $10,920. All other information is the same as before. In this quick check problem, the actual payment for quantity purchased is given at $10,920. The actual quantity purchased, AQP, is given at 2,800 pounds. Similar to the earlier calculations, we change one figure from the right from the second row onwards. Hence we have standard price identified at $4 per pound, resulting in a reference at $11,200. The price variance therefore is $280 favorable, as the actual spending is less than the expected sum. In the third row, instead of getting the flexible budget, we change the actual quantity purchased to the actual quantity used, because in this scenario the quantity purchased is different from the quantity used. The company purchased more than it consumed in the production, leaving some material weakness inventories. Differences between the second and the third rows, the actual quantity purchased minus actual quantity used times standard price, represents inventory movement valued at standard cost. So in this problem, the purchased quantity is higher than the quantity used, showing an unfavorable value of $4,400, which represents the value of the inventory increase. When comparing the third and fourth rows, we are examining the difference between actual quantity used and standard quantity allowed for the actual output. Therefore, it is a comparison on the actual usage, 1,700 pounds, and the standard usage for the actual production level, 1,500 pounds, giving rise to the usage variance. So in this question, the actual quantity used valued at standard cost, $4 per pound, is higher than the expected amount, the flexible budget, by $800, therefore the usage variance is unfavorable. Hansen actually paid $10,920 for the 2,800 pounds of material. Multiplying the standard of $4 per pound times the 2,800 pounds of material purchased, we find that the solution should have been $11,200. The price variance is now $280 favorable. The price variance increases in this example because the quantity purchased increased. The $280 favorable price variance results because Hansen paid 10 cents per pound less than standard for the 2,800 pounds of material. The material quantity variance is the same as before because Hansen again used the same amount of material as before to make the same number of zippies. So learning objective number 3, let's compute the direct labor rate and efficiency variances and explain their significance. Now let's turn our attention back to Glacier Peak Outfitters to illustrate the computation of labor rate and efficiency variances. Similar to material cost variances, labor cost variances can be done in the same calculation procedures. Due to the fact that labor costs are determined by hours paid divided by hours worked, therefore the calculations are based on labor hours instead of quantity purchased or produced. Similarly, purchase price is replaced by hourly rate. Using the same principle, we can compare the actual cost paid, $26,250, which is the first row, and the actual hours paid at the standard rate, $25,000, which is in the second row, giving rise the rate variance of $1,250 unfavorable as the actual cost being higher than the expected sum. When comparing actual hours paid at the standard rate, which is the second row, the flexible budget, the third row, the difference is $1,000 unfavorable. This variance represents the inefficiency of worker because actual hours paid and worked is 100 hours more than the standard hours allowed for the actual production output. The labor rate variance, defined as the difference between the actual hourly wage paid and the standard hourly wage, is $1,250 unfavorable. The rate variance is labeled unfavorable because the actual average wage rate was more than the standard wage rate by 50 cents per hour. The labor efficiency variance, defined as the difference between the actual quantity of labor hours and the quantity allowed according to the standard, is $1,000 unfavorable. The efficiency variance is labeled unfavorable because the actual quantity of hours exceeds the standard quantity allowed by 100 hours. So the actual price or rate of $10.50 per hour is computed by dividing the actual total cost for labor by the actual number of hours worked. The standard quantity of 2,400 hours is computed by multiplying the standard hours for one parka times the number of parkas made. Factored equations can also be used to compute the rate and efficiency variances. Labor variances are partially controllable by employees within the production department. So, for example, production managers, supervisors can influence the deployment of highly skilled workers and less skilled workers on tasks consistent with their skill levels, the level of employee motivation within the department, the quality of production supervision, the quality of training provided to the employees. However, labor variances are not entirely controllable by one person or department. For example, the maintenance department may do a poor job of maintaining production equipment. This may increase the processing time required per unit, thereby causing an unfavorable labor variance efficiency. The purchasing manager may purchase lower quality raw materials, resulting in unfavorable labor variance for the production manager. Let's return to the Hansen Company and compute labor variances. The direct labor standard to produce each zippy is 1.5 hours at $12 per hour. Last week it took 1,550 direct labor hours to produce 1,000 zippies, and the total labor cost was $18,910. Next, we will see several questions based on the information on this screen. So, in this quick check problem, Hansen Inc. incurred the actual labor cost of $18,910. The actual hours paid and worked is given by 1,550 hours. Similar to the earlier calculations, we change one figure from the right, from the second row onwards. Hence we have standard rate identified at $12 per hour, resulting in a reference of $18,600. The rate variance, therefore, is $310 unfavorable, as the actual spending is more than the expected sum. In the third row, determining the flexible budget, we can change the actual hour worked, which is AH, to the standard hour allowed for the actual production, SH, to help identify labor efficiency. In this area, the actual hour worked of 1,550 hours at standard labor hourly rate of $12 per hour, valuing $18,600, is higher than the expected amount, the flexible budget, by $600, resulting an unfavorable efficiency variance of $600. The value flexible budget, $18,000, is determined by the multiplying the actual amount, 1,000 zippies, with the standard hours required to produce each zippy, 1.5 hours, and the standard labor hourly rate of $12 per hour. So, what is Hansen's labor rate variance for the week? We find the actual labor rate by dividing the $18,910 total labor cost by 1,550 direct labor hours actually worked. Now that we know the actual labor rate, let's calculate the labor rate variance. We find the labor rate variance by multiplying the actual labor hours worked times the difference between the actual rate per labor hour and the standard rate per labor hour. The $310 unfavorable labor rate variance results because Hansen paid 20 cents per labor hour more than standard for 1,550 hours actually worked. So, what is Hansen's labor efficiency variance for the week? The total standard hours for labor is the amount of time Hansen's employees should have worked to make 1,000 zippies. We find the total standard hours by multiplying the 1.5 standard hours for 1 zippy times the 1,000 zippies made. Now that we know the total standard hours, let's calculate the labor efficiency variance. We find the labor efficiency variance by multiplying the standard rate for 1 hour of labor times the difference between the actual hours of labor and the standard hours of labor. The $600 unfavorable labor efficiency variance results because Hansen's employees worked 50 hours more than standard to make 1,000 zippies, and each hour of labor has a standard rate of $12. So let's do a quick check. Here we see a summary of the labor rate and efficiency variance computations in a convenient 3-column format. Learning objective number 4, let's compute the variable manufacturing overhead rate and efficiency variances. Now that we have studied material and labor variances, let's take a look at a variable manufacturing overhead variance. We will return to the Glacier Peak Outfitters to illustrate the computation of variable manufacturing overhead rate and efficiency variances. Identical to labor variances, variable manufacturing overhead variances are calculated in the exact format introduced. In the Glacier Peak Outfitters example, the actual expenses on variable manufacturing overhead, which is actual hours times actual R, is 10,500 with 2,500 hours incurred. At the standard variable overhead rate of $4 per hour, the actual hour at the standard rate, AH times SR, stands at $10,000, giving rise to $500 unfavorable rate variance. When comparing with the flexible budget, SH times SR, of $9,600 based on 2,000 parkas produced at the standard of 1.2 hours and standard hourly labor rate at $4 per hour. The unfavorable $400 efficiency variance was caused by the extra 100 hours incurred compared with the standard hours allowed for the actual output of 2,000 parkas. The variable overhead rate variance, defined as the difference between the actual variable overhead costs incurred during the period and the standard cost that should have been incurred based on the actual activity of the period, is $500 unfavorable. The rate variance is labeled unfavorable because the actual variable overhead rate was more than the standard variable overhead rate by 20 cents per hour. The variable overhead efficiency variance, defined as the difference between the actual activity of a period and the standard activity allowed, multiplied by the variable part of the predetermined overhead rate, is $400 unfavorable. The efficiency variance is labeled unfavorable because the actual quantity of the activity hours exceeds the standard quantity of the activity allowed by 100 hours. The actual price of $4.20 per hour is computed by dividing the actual total cost for variable manufacturing overhead by the actual number of hours worked. The standard quantity of 2,400 hours is computed by multiplying the standard hours for one parka times the number of parkas made. Factored equations can be used to compute the rate and efficiency variances. Now let's return to the Hansen Company and compute the variable manufacturing overhead variances. The variable manufacturing overhead standard to produce each zippy is 1.5 hours at $3 per hour. Last week, it took 1,500 hours to produce 1,000 zippies, and the total variable manufacturing overhead cost was $5,115. Next, we will see several questions based on the information on this screen. To calculate variable manufacturing overhead variances of Hansen Inc., we can apply the same formats as the labor variances. The actual expense of $5,115 is $465 more than the actual hours incurred at the standard rate. The unfavorable rate variance is caused by the actual and standard rates differences. The unfavorable efficiency variance of $150 is caused by a difference between the actual hours of 1,550 incurred and the standard hours allowed for the actual output of 1,500, which is calculated based on the actual output of 1,000 zippies at the standard of 1.5 hours, valuing at $3 per hour. So what is Hansen's rate variance for variable manufacturing overhead for the week? We find the actual variable manufacturing overhead rate by dividing $5,000, 115 total variable manufacturing overhead cost by $1,550 of direct labor hours actually worked. Now that we know the actual variable manufacturing overhead rate, let's calculate the variable manufacturing overhead rate variance. We find the variable manufacturing overhead rate variance by multiplying the actual hours worked times the difference between the actual variable manufacturing overhead rate per hour and the standard variable manufacturing overhead rate per hour. The $465 unfavorable variable manufacturing overhead rate variance results because Hansen's actual variable manufacturing overhead rate per labor hour is 30 cents per hour more than the standard variable manufacturing overhead rate per hour for the 1,550 hours actually worked. So what is Hansen's efficiency variance for variable manufacturing overhead for the week? The total standard hours is the same amount of time Hansen's employees should have worked to make 1,000 zippies. We find the total standard hours by multiplying the 1.5 standard hours for one zippy times the 1,000 zippies made. Now that we know the total standard hours, let's calculate the variable manufacturing overhead efficiency variance. We find the variable manufacturing overhead efficiency variance by multiplying the standard rate for variable manufacturing overhead times the difference between the actual hours of labor and standard hours of labor. The $150 unfavorable variable manufacturing overhead efficiency variance results because Hansen's employees worked 50 hours more than standard to make 1,000 zippies at a standard variable manufacturing overhead rate of $3 per hour. Just as we did with labor and material variances, we can summarize the variable manufacturing overhead variance computations in a convenient 3-column format. All variances are not worth investigating. Methods for highlighting a subset of variances as exceptions include looking at the size of the variance and looking at the size of the variance relative to the amount of spending. Plotting variance analysis data on a statistical control chart is helpful in variance investigation decisions. Variances are investigated if they are unusual relative to the normal level of random fluctuation and an unusual pattern emerges in the data. Research has shown that a substantial portion of companies in the UK, Canada, Japan, and the US use standard cost systems. This is because standard cost systems offer many advantages, including standard costs are a key element of the management by exception approach, which helps managers focus their attention on the most important issues. Standards that are viewed as reasonable by employees can serve as benchmarks that promote economy and efficiency. Standard costs can greatly simplify bookkeeping. Standard costs fit naturally into a responsibility accounting system. But the use of standard costs can also present a number of problems. For example, standard cost variance reports are usually prepared on a monthly basis and are often released days or weeks after the end of the month. Hence, the information can be outdated. If variances are misused as a club to negatively reinforce employees, morale may suffer and employees may make dysfunctional decisions. Labor variances make two important assumptions. First, they assume that the production process is labor-paced. If labor works faster, output will go up. Second, the computations assume that labor is a variable cost. These assumptions are often invalid in today's automated manufacturing environment where employees are essentially a fixed cost. In some cases, a favorable variance can be as bad or worse than an unfavorable variance. Excessive emphasis on meeting the standards may overshadow other important objectives such as maintaining and improving quality, on-time delivery, and customer satisfaction. Just meeting standards may not be sufficient. Continual improvement using techniques such as Six Sigma may be necessary to survive in a competitive environment. So, learning objective number 5. Let's compute delivery cycle time, throughput time, and manufacturing cycle efficiency, MCE. Delivery cycle time is the elapsed time from when a customer order is received to when the completed order is shipped. Throughput, manufacturing cycle time, is the amount of time required to turn raw materials into completed products. This includes process time, inspection time, move time, and queue time. Process time is the only value-added activity of the 4 times mentioned. Manufacturing cycle efficiency, MCE, is computed by dividing value-added time by manufacturing cycle, throughput time, and MCE less than 1 indicates that non-value-added time is present in the production process. Next, we will look at a series of questions dealing with delivery performance measures. Here's your first question on delivery performance measures. What is the throughput time? Throughput time is the sum of process time, inspection time, move time, and queue time. The total of these 4 times is 10.4 days. Here's your second question on delivery performance measures. What is the manufacturing cycle efficiency? Manufacturing cycle efficiency is found by dividing value-added time by throughput time. Process time is the only value-added time. Process time of 0.2 days divided by throughput time of 10.4 days results in a manufacturing cycle efficiency of 1.9%. Here's your third question on delivery performance measures. What is the delivery cycle time? Delivery cycle time is the sum of wait time plus throughput time. The total of these 2 times is 13.4 days. Now, predetermined overhead rates and overhead analysis in a standard costing system. The row-by-row model can be expanded to cover budgeted figures to calculate activity variance, which is flexible budget minus master budget, and static variance, which is actual results minus master budget. So for example, the raw material flexible budget calculation being SQ times SP equals the actual output times standard quantity for the actual output times standard price. The line-by-line calculation moves one line down and changes the actual output to budgeted output. That means the final line is budgeted output times standard quantity for the budgeted output times standard price equals master budget for the raw material. With the master budget being fit in the framework, we can calculate the activity variance and static variance with ease. So let's look at this example for Larry's Lawn Service. The variances calculated can then be presented and reconciled in a performance report as shown here. Actual results and master budget results can be reconciled with the differentiation from the activity variances and operating variances on revenue and spending differences. Now, predetermined overhead rates and overhead analysis in a standard costing system. So let's do learning objective number 6. Compute and interpret the fixed overhead budget and volume variances. The model for calculating fixed overhead variances is slightly different from the rest of the variable cost-based model. Fixed overhead remains the same within the relevant range. Change of activity level within the relevant range does not affect the value. Therefore, the second row after the actual expense of fixed overhead is based on the budgeted fixed overhead instead of actual activity level at the standard rate. The actual expense compared with the budgeted expense provides the budget variance, also known as spending variance. When comparing the budgeted fixed overhead, the second row, with the flexible budget, the third row, which is based on the standard hours allowed for the actual output, actually matches with the fixed overhead applied, we can determine the volume variance, the difference between the activity level estimated during the budget and the standard activity level allowed for the actual output valuing at the standard rate. Here we see the general model for computing fixed overhead variances. The budget variance is the actual fixed manufacturing overhead cost minus the budgeted fixed manufacturing overhead. The volume variance is budgeted fixed overhead minus the fixed overhead applied to work in process. The volume variance can also be computed by multiplying the fixed portion of the predetermined overhead rate times the difference between denominator hours and standard hours. The equation on the prior slide and this equation result in identical answers. Both variance computations will be demonstrated in the forthcoming example. Coca-Cola's production and machine hour data is shown here. Coca-Cola's overhead production costs are presented here. The predetermined overhead rate is equal to the estimated total manufacturing overhead cost divided by the estimated total amount of the allocation base. Cola's predetermined overhead rate is $4 per machine hour. The predetermined overhead rate can be broken down into a variable component and a fixed component. The variable component is $1 per machine hour. The fixed component is used to compute the volume variances is $3 per hour. The total overhead applied to work in process is computed by multiplying the predetermined overhead rate times the standard hours allowed for the actual output. The total overhead applied to work in process is $336,000. In the job order costing lecture, we use the actual level of activity to apply overhead costs to work in process. The different approach arises because we are using a standard cost system. Here, the actual and budgeted fixed overhead are given as $280,000 and $270,000 respectively, giving rise to $10,000 unfavorable budget variance. When comparing the budgeted overhead of $270,000 and the applied overhead, we can determine the volume variance where applied overhead being the product of the actual output, the standard machine hours for each production unit, and the predetermined overhead rate, giving rise to a total of $252,000. The volume variance calculated therefore is $18,000 unfavorable. The total fixed manufacturing overhead variance, $28,000 unfavorable, represents the total underapplied fixed manufacturing overhead, as the total applied overhead is less than the actual expense. The budget variance of $10,000 is the difference between the actual fixed overhead of $280,000 and the budgeted fixed overhead of $270,000. The variance is labeled as unfavorable because the company actually incurred more costs than the budget projected. The volume variance is budgeted fixed overhead minus the fixed overhead applied to work in process. The fixed overhead applied to work in process is equal to the fixed component of the predetermined overhead rate times the standard hours allowed for the actual output. The fixed overhead applied to work in process is computed by multiplying the fixed component on the predetermined overhead rate $3 by the standard machine hours allowed for the actual output, 84,000 hours. The volume variance is $18,000 unfavorable. The volume variance can also be computed by multiplying the fixed portion of the predetermined overhead rate times the difference between denominator hours and standard hours. The volume variance is $18,000 unfavorable. Because the standard hours allowed is less than the denominator volume hours, it presumably signals inefficient usage of facilities. Therefore, the variance is labeled as unfavorable. So here we see a pictorial view of the computation of the fixed overhead budget and volume variances. Often it's helpful to look at fixed overhead relationships in graphical form. We will use the Cola Company data from the previous example. The vertical axis is used to graph fixed overhead cost. The first cost that Cola would plot on this axis is $270,000 of budgeted fixed overhead. The horizontal axis is used to graph the volume of activity. The first activity level that Cola would plot is its denominator activity level of 90,000 machine hours. The linear manner in which fixed overhead is applied to products is depicted by drawing a straight line from the origin to the intersection of the budgeted fixed overhead and the denominator activity. The slope of this line indicates that fixed overhead is applied at a rate of $33 per machine hour. Next, plot the actual amount of fixed overhead costs on the vertical axis. The broken horizontal line above the budgeted fixed overhead represents the $280,000 of actual fixed manufacturing overhead. The vertical distance between the budgeted fixed overhead line and the actual fixed overhead line represents the fixed overhead budget variance of $10,000. Since the actual fixed overhead is greater than the budgeted fixed overhead, the fixed overhead budget variance is unfavorable. Finally, identify the standard hours allowed for the actual level of output, 84,000 hours, on the horizontal axis. Draw a vertical line from this activity level until it intersects the sloped line that depicts the fixed overhead applied to products. From this point, draw a horizontal line representing the fixed overhead of $252,000. The vertical distance between the budgeted fixed overhead line and the applied fixed overhead line represents the fixed overhead volume variance of $18,000. Since the budgeted fixed overhead is greater than the applied fixed overhead, the volume variance is unfavorable. In a standard cost system, the sum of the overhead variances equals the under or over applied overhead costs for the period. Unfavorable variances are equivalent to under applied overhead. Favorable variances are equivalent to over applied overhead. So this slide shows how Cola Company's under applied or over applied is computed. The total manufacturing overhead, variable and fixed, is $44,000 under applied. The variable overhead variances of Cola can be done using the previous layout and method, comparing the actual spending, AH times AR, of $100,000 with the actual hours, 88,000, at the standard rate, $1 per hour, AH times SR equals $88,000, which gives rise of $12,000 unfavorable rate variance. Moving down the rows, we can compare the second and third rows to derive the efficiency variance of $4,000 unfavorable. The second row represents the actual machine hours at standard rate AH times SR, which totals $88,000. The third row is the applied overhead SH times SR equaling $84,000, a product of the standard machine hours allowed for the actual production at the standard predetermined overhead rate of $1 per machine hour. The total unfavorable variable overhead variance of $16,000 is a combination of the rate and efficiency variances. It is also the difference between the actual spending and the applied variable overhead, implying the under-applied variable overhead of $16,000. COLA's variable overhead rate variance, $12,000 unfavorable, is computed as shown on this slide. COLA's variable overhead variance efficiency is $4,000 unfavorable, and it's shown here. The sum of the variable and fixed overhead variances is $44,000 unfavorable. Notice the sum of the variances equals the amount of COLA company's underapplied overhead. So here are the journal entries to record variances. So our learning objective is to prepare journal entries to record standard cost and variances. Standard costs and variance analysis can be used without formal journal entries. However, recording inventories and cost of goods sold using standard costs simplifies bookkeeping since it eliminates the need to keep track of the actual costs of each unit. The first entry is to record the purchase of direct materials. A favorable materials price variance is recorded with a credit. The second entry is to record the use of material. The use of material involves the transfer of material from the asset account raw materials inventory to the asset account work in process inventory. An unfavorable materials quantity variance is recorded with a debit. Here we see the entry for the incurrence of direct labor. Both labor variances are unfavorable and recorded with debits. The entries into the various accounts are made at standard cost, not actual cost. The differences between actual and standard costs are entered into special accounts that accumulate the various standard cost variances. Standard cost variance accounts are usually closed out to cost of goods sold at the end of the period. Unfavorable variances increase cost of goods sold, and favorable variances decrease cost of goods sold.